Good Tuesday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, Dimitri Pargamonic. How you doing, D?
Good morning, Will. How are you?
Great. You want to start with the disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I and Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor, call your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer.
Excellent.
And I'm going to share my screen. If anybody is joining us for the first time, as a quick note, Will and I, we do these shows in the morning to try to help answer questions you may have about the Market Chameleon tools, the data, or the analytics. If you have a question, you could type it into the live chat on YouTube. Will's watching it. He'll read them back to me. If you would like to come on a show and ask your question live, we also provide a link to Zoom. If you click on that link, when you log into Zoom, there's a little button at the bottom of your screen. It says raise your hand. Click on that. That signals to us that you're trying to ask a question. Once we let you in, you could ask your question live and direct. And while we're waiting for you guys to type in your questions and for more people to join, we're going to give it a couple minutes and start out taking a look at the pre-market report to see if we could get insights on what's going on in a pre-market hours, and then we'll move on to the questions. All right. So pre-market report, these are stocks that are trading in a pre-market hours. I'm going to scroll down here, and we have a list of our most active stocks, our biggest percentage gainers, biggest percentage decliners. I see there are 37 stocks made our percentage gainers list, 45 that made our percentage decliners list. So from this perspective, looks like we're slightly bearish in the pre-market hours. So the trading, if we take the trading from that perspective, looks like there's a slight bearish bias. Let's take a look at it from another perspective. I'm going to climb up here back to the top, and we have this calendar view. If you click on it, it takes you back days and shows you a summary of what happened that day in the pre-market hours. September 26th, that's today, we see 221 stocks are trading higher in the pre-market hours, 380 stocks trading lower. We have 147 million shares of stocks on up volume versus 61.8 million on down volume. And if we convert those shares to dollar value, so not all shares are the same. We have penny stocks, we have $100 stocks, $200 stocks. If we convert it to dollar value, we got $608 million worth of stock trading higher, $1.7 billion worth of stock trading lower. So that also indicates that the sentiment in the pre-market hours right now is leaning towards the bearish side. Let's look at it from one more perspective, then we're going to go on to the questions. And I'm going to come back down to this list. When we look at this list, we see that there are stocks in there that are low cap stocks, ETFs. We have closed-end funds, leverage products, preferreds. So pretty much any security listed on a major U.S. exchange, if it's trading in the pre-market hours and meets our liquidity thresholds, volume, and price, it can make this list. To narrow it down to a smaller group of stocks, we could use the filters here above. And if you have a watch list, you could filter by your watch list. I'm going to use this one in ETF. Click on it. You get a drop-down menu, different ETFs to choose from. Let's pick SPY. That's S&P 500 ETF. When we do that, the list below gets filtered by stocks that are holdings in SPY. Here we see one stock made our percentage gainers list, 3 on the decliners. Again, these have to meet certain thresholds to make the list, but still looks to me so far that the trading in a pre-market hours is leaning bearish. So we gave it a couple minutes, Will. We did have a question left over from yesterday. Maybe I'll answer quickly, and then if we have more questions, we'll move on to new questions from today.
Yeah, I know I lost ability to be heard by you yesterday at some point. So we did, I think Rob's on. He did also had a question about the feature you were showing yesterday, when that would be available. I think that was also an outstanding question. And then we also had a question about the open interest. Is there a way to view it intraday? And
Right.
that was the other question.
Okay, thanks. So, yeah, I did go over a feature yesterday just to get some insights. I'm going to try to push this out, this feature over here. I'm going to try to push it out because I have internally different variations of it, but maybe the basic feature, I'll try to push it out by next week, just so you guys could just start playing with the calculator. It's a simple calculator. We went over it yesterday, but I'll make a note of it to push out like the basic one next week. What was the other question?
It was I'll read it verbatim. It was Ivanish was on. Is there a means where I can see call open interest versus put open interest change in a graphical format intraday in Market Chameleon?
Okay. So, and this is actually a question I get a lot from people who want to look at open interest on the options chain. And over here, we could see the open interest per contract, right? This is for the calls. If we want to see the puts, we have the open interest for the puts on this side. And the question is, well, can I see this changing intraday? So if there's volume going on right now, right, like the volume is going up, is this open interest going down or going up relative to the traded volume right now? And open interest itself does not update throughout the day intraday. Okay. The open interest is calculated by the Options Clearing Corporation. So the Options Clearing Corporation clears all the options, right? They're the clearing, they clear all the options, and they base the open interest, this number, that's where it comes from, right? That's who the official source that calculates it. They calculate the open interest based on end of day settled trades. Then they take into consideration anybody exercising, splits, assignments, expirations. All this goes into the calculation of the new open interest. So it happens overnight, right? So that's what it's looking at: the settled trades, end of day, taking into consideration all those other things I mentioned with, early exercises, assignments, expirations, all this stuff, splits. And then overnight, it calculates it and produces the new open interest the next business day. So there's one number per day, right? There's only one number that we get per day. It comes from the OCC. We get it in the morning and we update in the morning. And until the next day, we don't know how the open interest will change until the OCC, does that calculation. Now, some people, so sometimes you hear, well, there's a trade and it's going to create new open interest, right? So here's a trade that happened, and this looks like a trade that will increase the open interest. So how do they know that? If we don't have an open interest that updates intraday, why would somebody say, oh, here's a trade and this is a new trade, creates new open interest? Well, if we see that on the start of day, let's say that the open interest is 0, right? The open interest is 0 start of day. And we see one trade with 1,000 contracts. Well, we could infer that is a new position that is, unless it's traded out by the end of the day or exercised, it's a new position they'll create new open interest because there was no position to close out of in the first place, right? So if 1,000 contracts traded with zero open interest, well, there's no 1,000 contracts to close. So it had to be, you're inferring that has to be a new position. So from monitoring the open interest, even in the morning, there are certain instances we could make inferences, right? We can make inferences of what may be going on given the surrounding circumstances, right? That's what people are trying to do, is use the information that is available to try to make inferences if there's an increase in open interest. And perhaps sometimes you can anticipate a closing position because if you have a big open interest that historically looks like it was from one big trade, and sometimes you see a big trade with the same amount of size on the same option, looks like it's a close, or looks like they're rotating to a different month. You could surmise, you can infer that might be a person that's closing their previous position, moving into the next, but there's no live. It's not like the volume. The volume will update throughout the day. So volume, every time there's a trade, it will increase the volume, right, throughout the day. So the volume will increase even if somebody bought an option in the morning and then sold it later on, the volume will increase because it's just calculating the amount of trades throughout the day. So that will continue to increase. Volume doesn't go back down. It could just go up, right? Open interest can go up and down, but that does not calculate or update intraday, right? And people, sometimes they disagree with me and they're like, I'm going to go find it. All right, you could go find it, or you could go to the OCC and read how open interest is calculated. But, that doesn't update throughout the day. At least I don't have any feed that I know of that could do that.
All right. Well, that answers the question.
Yep. All right. So the two questions, open interest and yeah, that feature I showed, I'll try to push it out, I'm still working on it, but I think like the basic calculator, I'll try to push it out next week, just so you guys have a chance to even play around with the basic calculator.
All right. We did have a question from Jackie and Rob popped up. Rob, actually,
Okay.
I'll do his first because he is asking about the relating in a similar way to the opening. He's like, is the order sentiment chart using options tab a chart using options transactions to create the chart? Does it relate in a similar way to open interest, i.e. more activity in the option?
Right. So this chart, the order sentiment, right? It's looking at only the volume throughout the day. Okay, so we don't know the open interest. We don't know if people are closing or opening, or we don't know that, until the next day. And we don't know that for each transaction, it would not be even, because there's a lot of open interest in, like, say, SPY, or there's a lot of trading going on in SPY back and forth that we don't even know, like, what the new open interest will lead to. So this is looking at the transactions. There's a trade, right? So every time there's a trade in an option, well, we know we could calculate that this particular option has a delta, right? So the delta is the sensitivity of the option to a dollar move in the stock. So the delta would be, what would the either side, right, to hedge that option? We could look at the delta and say, that one side to hedge the option would have to buy 500 shares, one would have to sell 500 shares, right? So if both sides try to hedge just that option, we could figure out what the delta would be, right? That's the Black-Scholes model. We could go in there and calculate that, which is, it's an approximation of a delta. And to go further, right, so that's just an accumulation of delta. It would be like an equivalent number of shares traded, the volume. right, in SPY. But to go further than that, can we get more insights? Is that because option orders, can mostly be put into buckets of market takers and market makers. So market takers are the end users that are trying to use the options for a certain purpose, certain outlook. Okay. The market makers are just providing the liquidity because they feel that the option is, fairly priced here, and they're willing to buy it and sell it around their fair value. Okay. So, and not all transactions are like that. Sometimes the transactions are matched up between end users, retail to retail. Sometimes it could be market maker to market maker. So not each transaction is a, end user retail customer transacting with a market maker. That's not always happening, but a lot of times it does happen. And why? Because, if you're looking to buy or sell an option, it's not likely that exactly at that moment there's another retail customer who wants to transact with you at exactly that price with exactly that amount, every time you enter in a trade. All right. So that's why the market makers are there. They're providing the liquidity, because it's like, if, even if Will and I wanted to buy something and I wanted to sell something, and we're two retail customers, the chances that we enter our orders exactly the same time and they match up, it's not likely. That's why there's market makers in there that are providing that liquidity. So this goes a little bit further and says, okay, based on the surrounding data, right? Just like we just did the open interest, based on the surrounding data, if we look at the transaction, we look at what the markets were, we looked at the implied volatilities, we look at our benchmarks, how these options trade, we look at all this stuff. Can we infer with some degree of confidence, right? Not with 100% confidence, but can we infer with some degree of confidence that this was most likely an incoming order to buy an option or sell an option? And if we can meet those conditions, we'll put it in a bucket. We'll say, this is what we infer happened with this transaction. If we can't, we have to put it into a bucket that's undecided, unknown. We don't know what, this could have been, just a cross customer match or market maker match. But if we could infer with some degree of confidence, we'll say, okay, this is what our sampling, this is what we think most likely happened. Somebody came in, and the end user bought options. And if they did, that means they created positive delta pressure, right? That means that if the market maker was on the other side, he took the negative delta, which at that moment would say, created a buy pressure on that equity. That's what's going on here. All right. And remember, these are inferences. When we talk about finance, very little sometimes is just given to you straightforward like that. You have to start using models to make inferences in what you think is likely happening, right? Because otherwise all you're getting is just raw data. You're just getting prices, and all you're getting is digits. So we have to run it through the models to think what is most likely occurred here, right? And that's what this is doing, right? So this is saying that yesterday, pretty much all day, this is the accumulation of deltas, right? So they just accumulate throughout the day as their new trades come in. It looks like it was pretty steady, on the positive sides. Then whatever happened right at the end, it looks like there was a big surge in positive deltas, right up here, and stayed like that to the end of the day. We don't know what the intent was. Could have been covering, it could have been whatever, but that was the positive surge that we inferred from yesterday.
Excellent. We had a question from Jackie. He's like, can Dimitri explain more about the different terms in conditions, stock contingent, multi-legs, intermarket sweep, and in execution, auto match, floor trade, which one is important? We only have about 8 minutes left. I don't know if you want to share that, save that for tomorrow, or go over it now. It's up to you.
Yeah, I could start going over it.
All right.
So when we look at option trades, I'll go here. There's certain data that they give us, and that's what helps us run the models, right? Because we could take data and then we could start running models to on the data. So the tape itself, you know, when a transaction happens, when a trade happens, there are certain details about the trade that we get. You know, and obviously the price and the volume. Here's a trade, the price and the volume. That's something we get. Then we could capture, you know, what the bid and ask was at the time, and then we could start analyzing some of this. You know, we could look at the notional value of the trade. Where did it trade relative to the bid and offer? Where was the stock at the time of the trade? What was the open interest? So all this stuff, then we could start to analyze to start putting the pieces to the puzzle, right, together, right? So like we just want insights, clarity of what's going on besides like volume. And, you know, if all you're looking at is just like volume and prices, then you have very little information to go on. And so on the trade itself, the Oprah feed also tells us the condition of the trade. Okay. And this one, these are in the options. And the condition of the trade can be, it could vary, right? Like because you could put it in a trade that you just want to buy or sell an option, right? So buying and selling an option, you could put that in and it could get executed different ways. It could just get auto executed, which means it went into the matching engine, right? And the matching engine matched it up, right? So it was electronically, it was just auto, like right away, it was just auto executed because the matching engine, you know, this is on ICE, this is on NASDAQ, its matching engine took your order and executed it against a different order, which could have been market maker or a you know, a resting order or whatever. So that's one way that the trade could have transacted. We have this intermarket sweep order. Well, what does that mean? Well, an intermarket sweep order is a special type of order. You'd have to actually designate it, entered in as an intermarket sweep order before you sent it out to through your broker, right? So you had to designate it intermarket sweep. We talked about the intermarket sweep, but this is a special order type which says the following. Look, I have, in this case, 174 options that this person wanted to execute, right? And we know from Reg NMS rules that your broker has a responsibility to get the best price first. So his responsibility is not to get you the best liquidity where you could execute 174 right away. It's to go after the best price first before going to a different exchange to get a new price. So let's just say the best price is $2.29. You want to sell this $2.29. Well, if there's one contract bid for, let's say on the CBOE, if there's one contract bid for $2.29, and then there's 10 contracts, $2.28 on a different exchange, and then $2.27 for 100 contracts on a different exchange, what does your broker have to do? First, he has to go and try to get that one contract. So you have 174 you want to sell, but the first thing your broker is doing is going to get the best price, even if it's only one contract. So he goes and tries to sell that at 229 and says, I have 174 to sell. Well, SIBO says, well, I only have one to buy. So you're matched up at one and there's no more to buy. So then your broker's like, okay, what's the next best price? 228. I go to now I leave SIBO, I go to the Amex and I sell them 10 at 228. Then you could see what's going on is that as you're doing it, what if the market moves against you, right? Because now you're trying to get the best price on each exchange. But as you're doing that, as it's cycling through the different exchanges routing in the routing system, the markets could move. And in actuality, even though you're trying to get the best price, your aggregated price could be worse if the market moves against you as you're trying to do it. Because as you're getting the 229, yeah, you got the 229, but that 228 bid, somebody else could have hit it, or the market maker moved it because the stock moved, and you could have missed out on, yeah, if you sold one at 229, but if the next 10 you miss the 228 and you have to sell it at 225, well, you're not really better off then, right? You should have just gone straight to the 228. So the intermarket sweep order does something different and says, look, I don't care about the Reg NMS rules. It doesn't work for me, right? So the Reg NMS rules is going to be, in my situation, it's more harmful than beneficial, because if I have 174 to go, I don't want to end up with a inferior average price. So what it says is bypass the Reg NMS rules and go and sweep all the top of book exchanges at simultaneously. I don't care, if there's 229 bid here for one and 228 bid for 10, go get them at the same time. I don't care if you execute the 228 first and then the 229 second, go get them at the same time. I don't want to take a risk that the market's going to move against me and then I got to go move mine. So that's what the intermarket sweep order does. So if you could get it all in one exchange, it'll do it, right? So this 174, he got it all in one exchange. It will do it. If it can't, it will go simultaneously to top of book on different exchanges to get to fill your order, right? Because you want to get what's important to you is that you get filled on your order and you're not chasing the markets. That's an intermarket sweep order. What is a multi-leg? Well, we know from options that a lot of the volume is a strategy based on a strategy, like a call spread, a put spread, a straddle. And when you do a strategy, well, your order that you could enter in a call spread order, right? You could enter in a straddle order, you could enter in a 5-leg order. And if your condition is that, I want to get filled on this strategy, on this call spread, I'm not doing one leg at a time, the condition is a multi-leg, meaning that this order over here, this multi-leg, is part of another order, right? It went to the complex order book, right? A multi-leg actually order goes through a separate engine. So when you enter in a single order, it'll go through a matching engine. A multi-leg order goes through a different engine with different rules because it's a complex order. You have multiple legs to the order that needs to get executed simultaneously. You can't just execute one leg of the order and say you're not, you entered in a bull call spread and you bought this option, you didn't sell this option, and that's it. It doesn't work that way. If you enter in a multi-leg order, like say, bull call spread for a limit price, it's either going to execute you on both sides of the order or not, right? Or you don't get one side of the order. And in order for that, to transact, it goes through a complex order book. So the options exchanges have their own complex order book that they match up multi-leg orders. All right. They have different actually rules around complex orders. And they don't, complex orders don't actually get posted to the OPER feed. Those are on a proprietary feed. So you don't even see the limit orders on the OPER feed. So, well, I'm going to end it here because it's 9:30. These are good questions, by the way, and I thank you for the questions. Really, it helps me a lot too, because I know where to focus on, and I'm not just randomly picking stuff. So thank you for the questions, and a lot of these questions that I get, recurring over time. So we go back and discuss it.
All right, great job. Thanks, Jackie, for the question. Rob, everyone, thanks for joining us. Good job, Dima. Thank you.
Thanks, everyone. Everyone stay safe out there. Have a great trading day.